reports a small convoy of about 20 trucks has entered Gaza through its border with Egypt. Lawmakers in the House will come back to Capitol Hill Monday with no House Speaker. Republicans have moved on from Congressman Jim Jordan as their nominee. That leaves the Republican conference with no nominee more than 2 weeks after the historic removal of Kevin McCarthy, who blames a handful of conservatives for the dysfunction within the party.
We are in a very bad position as a party, one that has won the majority, one that America has entrusted us with, that a simple 8 people have put us in this place.
While Republican from Oklahoma Kevin Hern has apparently changed his mind and is now running for the Speaker position. United Auto Workers President Shawn Fain says the union is seeing progress from GM and Stellantis and is not expanding the strike against Detroit's big 3 automakers, though Ford is now asking another 364 workers in Michigan and Ohio to not to come to work Monday. The automaker saying last night it's a consequence of the ongoing strike. Scott Carr, NBC News Radio.
This is Chicago's Progressive Talk, 820 AM, WCPT Willow Springs, and online at WCPT820.com, where facts matter.
In 2023, WCPT 820 is where facts matter.
Information is power.
In-depth analysis. Thought-provoking conversation.
Stay informed to know what's going on.
People are demanding that their voices be heard.
Chicago's Progressive Talk is WCPT 820, where facts matter. You've been working hard all day and didn't have time to catch up on the news during work.
And that phone just wouldn't stop.
We've got you covered. Joan Esposito, live, local, and progressive.
We will fight as many places and as many times as it takes to get this power back.
Joan Esposito, afternoons from 2 to 5 p.m. WCPT 820.
Manipulating the masses is more utilizing propaganda, gaining a wide quadrant of the public, where crowd manipulation is more focused. Like the divisionary tactics of these political parties. They utilize certain talking points and phrases to target specific groups that they want to maneuver and empower and get them to do their bidding.
Think Theory Radio with Damian Perdue. Saturdays at 6 p.m. on WCPT 820.
This is your WCPT Progressive Calendar. Tuesday, October 24th at 7 p.m., the Glenview Public Library will be hosting community conversations and interfaith dialogue. The panel discussion will include Catholic, Jewish, Islamic, and Baha'i faith leaders. The event takes place in the community room of the Glenview Public Library at 1930 Glenview Road. Registration is required. Wednesday, October 25th at 6:30 p.m., Congresswoman Delia Ramirez will be holding a virtual town hall. Register today at facebook.com/Rep Delia Ramirez. Tuesday, October 31st at 12:30 p.m., the University of Chicago Crown Family School of Social Work, Policy, and Practice presents a lecture on the financialization of health politics with University of Chicago professor Colleen M. Grogan. The event is free and open to the public. 969 East 60th Street in Chicago.
Do you have an invention idea but don't know what to do next? Call InventHelp today. We have representatives nationwide who will explain the InventHelp process step by step. Over 10,000 patents have been secured through InventHelp's patent referral services. The InventHelp Databank includes thousands of companies who have agreed to review new ideas. We've been helping inventors since 1984. Let's help you next. Get started today.
Call 1-800-217-4380. That's 1-800-217-4380. Again, 1-800-217-4380.
Sometimes life is wonderful, and sometimes it's not. Cherish the good, but always be prepared for life's challenges. At Private Healthcare, we provide the peace of mind you deserve. Private Healthcare is private health insurance for ages 65 and under with medical, dental, vision, and even prescription coverage. Call 800-581-9073. That's 800-581-9073. 800-581-9073.
The following program, Real Estate Radio, is sponsored by Trusted Agent USA, and to the extent applicable, their guests. The views and opinions expressed therein do not necessarily reflect those of NewsWeb Radio Company or its management.
Welcome to Real Estate Radio, hosted by the real estate therapist Larry Shakman, a top producing real estate broker, author, CEO, and founder of TrustedAgentUSA.com, the ultimate real estate matchmaker, connecting you with top performing agents for 2% commission. Each week, we bring you exclusive interviews with industry experts, covering everything from staging to negotiation strategies to home inspection issues and everything in between. Whether you're selling your home, a first-time home buyer, or a seasoned investor, we've got you covered. Let's make your real estate dreams a reality in this fast-moving and ever-changing real estate market. This program is funded in whole or in part by Trusted Agent USA, Illinois license number 475-145-795. Now, here's Larry.
Good morning, everybody. This is Dylan Kramer, not Larry Shakman. I am flying solo on the Real Estate Therapist's couch today. Larry's a little bit under the weather, so we're going to spend the next hour not only wishing him well, but talking a little bit about a few real estate things as we go through today's kind of program and protocol. We'll keep most of everything on the show today to the same. We're going to talk about rising mortgage rates, rising insurance expenses that people have on a month-in, month-out basis. Remember that Larry and I have worked in real estate for a long time, so we bring our experience to you every week on this show. Larry's with eXp Realty and has been there for 23 years. I am with Benchmark Mortgage as a mortgage loan originator and branch manager, and have been there. Well, I've been at Benchmark for 7 years. Not that you need the resume, but I've been in mortgage lending for 30 years. So what I tell everybody is what we're seeing today in the mortgage and real estate space is nothing new, and it's always a changing market. So if you have questions today, we'd welcome your calls or texts at 773-763-9278. Again, 773-763-9278. You can call or text that number, and we can talk real estate for the next hour. We're also broadcasting live on Facebook, on WCPT's Facebook page, so you can find us there. And if you need to find Larry, you can find him at Larry Shakman on YouTube. So first and foremost, let's, as we always do, thank our sponsors. We're going to first thank Trusted Agent USA. Trusted Agent USA lets you turn around and buy for significant savings and get that money moved to the bottom line. And then, of course, my company, Benchmark Mortgage, is a sponsor of the show. We help folks buy, sell, and refinance no matter what the market is. We help people in challenging situations. We'll talk a little bit about that every day, or a little bit later today when we talk about reverse mortgages. We're going to talk a little bit about folks who are getting divorced, and we're going to talk to folks who are serving as veterans. So it looks like we've got a call. We're going to jump in right away. I appreciate you calling in. Chris, tell us a little bit about your real estate question. What can I answer for you? Welcome to the Real Estate Therapist couch.
Thank you. Thanks for taking my call. I'm 31 years old, and I first-time buyer, and with the rates, any first-time buyer program that you could recommend?
You know, Chris, when I hear you say first-time buyer program, the thing I always ask you is, ask somebody who asks that question is, are you asking me, hey, is there any free money out there for people who are buying for first-timers, right? But you're too polite to ask that. Is that what you're asking me?
That's correct.
All right. So here's the thing. At the end of the day, there are lots of opportunities to buy no money down. And that's really, I think, the biggest question. So I'll tell you, the short answer to your question is no, but not for the reason you think. All of these buyer assistance programs, they all come with a catch, right? So at the end of the day, if you are going to turn around and, for example, get a mortgage for, and let's say you're going to put a 3.5% down payment mortgage, but you're going to put zero down. Well, the 3.5% has to come from somewhere. There are several programs out there available that will dress up like grants. And so if rates today are at 8, they'll give you the money, but you have to repay it over the course of the next 5 years at 10%. Well, rates are at 8. Why would you take money at 10? And that's the catch, right? Because you don't have the money. The other thing is there are programs out there that will just say, hey, look, you're going to pay us this money. We'll loan it to you. We're going to loan it to you at that high rate, but you don't have to make a payment. You just have to pay it when you sell the house or refinance. And then you go about your business and you wake up a couple of years later. And you're like, hey, I'm going to sell. And they're like, oh, by the way, you have to pay these other people $10,000 or $15,000 or whatever they helped you with. So free money is not really available. There's always a catch. However, I would tell you that trying to find a program that can work for you is absolutely a thing. So we can take your number and phone you afterwards. It's a great question to try and buy no money down. Have you been in the marketplace for long? Like, have you looked at properties already? I mean, I know it's not easy out there.
Yes, me and my wife, we have, and it's really tough.
I understand
I live in
that.
the DuPage County area, so it's very expensive. Mm-hmm.
Yeah, I understand that. Well, Chris, not to get, I appreciate the call, but what I would tell you is I don't want to go into your personal information on the air, but we've taken your number down, and if you don't mind, I can certainly follow up with you after the show, and we can talk in a little more detail about your specific situation, because the thing I would tell you is, although there's not free money out there for you, there is an answer for you to get this thing solved and get a house under contract. Is that fair?
That's fair. Thank you so much. I appreciate it.
Not a problem at all, man. I appreciate the call today. Thanks for calling and spending a little time on the Real Estate Therapist's couch.
All right, thanks.
All right, have a great day. We'll talk soon.
Right. You bet.
Awesome. That was Chris, and that's fantastic. I appreciate him jumping in. One of the things Chris had mentioned in the conversation that we talk about here every week is mortgage rates. And we've had we have two things, I guess, to share today on mortgage rates. You've heard Larry and I have a lot of back and forth over the last couple of weeks here on the couch, where Larry has kind of advocated for this idea that rates are going to be lower in the spring, and he may be right, and I hope that he's right. But I've also talked and will say again today, look, if you're like Chris in the market for a house, maybe you want to stop renting. We didn't get into that with Chris, but you're, the profile of the person, if you've got your 2.5% mortgage, you're not a candidate to move or leave or go anywhere else unless you take a job transfer or you get unfortunately divorced or there's some other financial problem that you have that changing houses solves. But if you're renting and you buy today, rising rates should not really have an impact. Now, they may make the home you want to target unaffordable, and that certainly can be a problem. However, only 3 things happen from today with interest rates. Number 1, rates stay the same. And if they stay the same and you can afford the payment and stop renting and get control of your interest rate situation, well, then you're 100%, you should be 100% on board with the idea of moving and buying your house. Number 2 is you should turn around and see that rates go up. When rates go up, you're going to thank your lucky stars you bought at 7.5 or 8. As a matter of fact, all the people who were fussing about 6% a year or a year and a half ago were finding themselves in a situation today where they actually are relieved that they don't have 8. And so if rates go up, you end up in a better spot. And then the thing is that rates go down. And if rates go down, 2 things are going to happen. The first one is people are going to start stampeding back into the real estate market because it's going to be quote unquote affordable again. But it'll only be affordable relative to what's happened over the course of the last 6 months or a year and a half. And all those people on the sidelines will come in, and instead of what we have today, which is sometimes 2 or 3 people bidding on every single house that's on the market of quality, you'll have a situation where you'll have 10 or 12 or 18 people bidding on houses again, like we had in 2021. And so to avoid that, you don't want to wait for rates to drop. If the math works today, you should be a buyer. Even at these rates. What happened to rates this week? Well, rates have, we had 2 things happen that are negative for rates. And I do think that rates are going to continue to increase. The first thing about rates is that we had Mr. Powell speak, and he turned around and when Mr. Powell came and spoke at the market, he's basically continuing his discussion that we are going to have higher rates for longer, that they want inflation to print at 2% for an extended period of time, and we keep seeing inflationary things in the market, and they keep driving rates higher. And as long as that's the case, Mr. Powell is not going to be lowering rates. And the market had kind of anticipated that we were expecting lower rates sometime between summer and fall of next year. I think that expectation is now tempered, and it's even further out. And because that expectation has kind of been blown up, rates have solidly moved to 8%. And so I think that that's an important part of the factor. And that will make housing more expensive over time. That's the second thing that's happened, is that we have committed more money to Ukraine. We've committed money to support Israel. And no matter what the politics of that are, or what your politics of that are, or your opinion of that is, the fact of the matter is, financially, in the financial markets, you're going to find yourself in a situation, if the government's going to borrow $100 million, $100 billion, $10 billion, it doesn't matter. They have to issue bonds. When they issue bonds, they have to come to the open market. More bonds changes the supply and demand equation and is inflationary, and thus will make housing payments more expensive. So that's the story on interest rates kind of for this week. I want to segue now. We're going to spend a little time with a guest here in a minute, but I want to tee this up and talk a little bit about why we're getting into this discussion. We've talked a little bit so far this morning about increasing interest rates and rising payments, and that's not the only thing that's contributing. You know, I've had several of my longtime clients reach out and send me their annual notice. When you got a mortgage, the servicing lender, or the folks collecting your payment every month, get the opportunity to once a year come in and review your expenses. They check your monthly collections. Let's say your property tax bill is $4,800 annually, and your insurance cost is $1,200 annually for a total of $6,000. They should be taking roughly $6,000 annually, or $500 a month, into your escrow account, or your for property taxes and insurance payments. But if taxes and insurance increase, then annually they'll come in and they'll take a quick look and tell you that we expect these costs to go up. You're not going to have enough money to pay the bill, and your monthly payment goes up. Well, one of the drivers of that is insurance. And so I've asked, as a special guest today, my personal insurance agent, who's also a broker, Todd Johnson, to join us and talk a little bit about the program. Todd, how are you?
Good morning. I'm doing great.
Todd, I appreciate you jumping in on short notice today to talk about insurance expenses. Tell from a background standpoint, tell everybody listening here today in the audience a little bit about yourself. How long you've been in the insurance business? How does your company work? What do you guys do specifically for homeowners? But I know you have a wide variety of services, so if you want to spray to all fields for a minute, I would appreciate it.
Sure. So we're a full-service financial services, group benefits, and insurance brokerage firm. I've been doing this for over 20 years. We do business in over 40 states, so we're not, we're not limited to any state. So we know the challenges facing pretty much the country from state to state across the coast. And the way we work is we're a broker. So we don't work with just one company. We work with over 20 different companies depending upon the market. Not every single insurance carrier operates in every single state. But the states that they do operate in, we can take out any individual's insurance and shop it out to all the markets that we have available, which is a huge advantage, especially in this market. I will say, as Dylan had just said, insurance costs are going up. In the insurance world, we call that a hardening market, meaning that carriers are raising rates, and everybody is saying this is one of the worst hardening markets they have seen, for a variety of factors that I think we'll talk about here in a few minutes.
Absolutely. As a matter of fact, Todd, let's jump into those, because I can turn around and tell folks how much I appreciate you and your company and what you guys do, but we'll do that at the end, because I really think that there's an endorsement there, especially if you're struggling with these costs and how to address them. But first, let's talk about this hardening market and these increasing insurance expenses. What do you think, and I know I'm putting the ball on the tee for you because we had this conversation one-on-one a couple of weeks back. What do you think is driving these elements? I know there are several factors, correct, that are increasing insurance costs.
Sure. So the biggest thing is the inflationary trends both on materials and labor. And that's going to be the largest driving force of that. When insurance carriers look at the cost to replace your home, and this is the biggest confusion that we have to kind of help educate all of our clients, is what somebody bought the house for and what the insurance company is going to put on as the replacement cost are two different things. In real estate, it's always location, location, location. So, a house in one town could be X and it could be 3 times the price in another town. But in reality, the cost to rebuild those homes, if they're the exact same year of construction and updates and everything, are probably going to be pretty even. So the insurance carriers all, and most of them in their contracts, and most lenders require what's called a replacement cost contract, meaning if the house burns down, they're going to have enough coverage to replace the house in the condition it was before it burnt down or whatever happened. And that replacement cost used to be hovering around $125 to $150 a square foot for most residential homes. For pretty much every carrier now, that's jumped to almost $250, and some carriers are pushing that up to $275, $300, and those numbers are based on their actual claims cost. Their claims data.
I was going to ask you that, Todd. The thing is that they can push those up, but those increases are really costs, are hard experiences, right? And I think that
yes.
I think when people say, well, why are things going that back up? The thing that I would tell you is, hey, remember, we had all those increasing lumber costs 18 months ago, right? And so in the real world, when you're rebuilding houses, that makes its way in. And it's not just the lumber, it's a bunch of other stuff too.
That is correct. So what a lot of carriers are doing is they're adjusting their rates, but a lot of them are also going and re-inspecting homes or looking at what's the square footage and what should the cost be, so they can capture the appropriate rate for the actual claims that they're going to pay out. That's one of the largest factors increasing. The other one is claims history. So it is incredibly important, and this goes into the auto as well, so I'll talk a little bit about this. I know this is more home-focused, but if an insured has 2 or 3 claims within a 5-year period, chances are most of the A-rated companies that you want to have coverage with are probably going to say, we're not even going to take you as a new customer anymore.
Oh, wow.
And a lot of it's gotten bad. There's one carrier in particular who used to say, especially on the auto side, we'll take everybody, we'll just charge for it. And they are starting to actually non-renew carriers, if the non-renew clients, if they have more than 2 or 3 claims in a 5-year period. So it's also, what we also do is act as the advisor to our clients, that sometimes if it's a small claim, if it's a small little leak behind the refrigerator that's going to cost you $500 or $750 to repair, we say, don't file that. That's probably not going to be the best use of your insurance dollars, because the cost you're going to pay in an increased premium or to shop that to a new carrier is not going to be worth it. So the number of claims is increasing this substantially. The other key thing here is the age of your roof.
It's funny you mentioned the roofing. I want you to talk a little bit about the age of the roof, but I know that when you and I discussed this offline, you also had mentioned, I don't necessarily want to call it, and so for everybody watching online, you can see me do the air quotes right now. I don't want to call it roofing fraud, but I would say that my understanding is that the roofing business has kind of found a source of funding in the insurance companies and is leaning into that. Is that probably a fair thing to phrase? And if that's the case, can you spray to all fields on that as well?
Yeah, I do want to be careful to make sure that we don't cross the line here, but there are a lot of issues going on with people knocking on your door after a rainstorm that they may say is hail, that they say now your roof has damage, and so they're going around and trying to get an insurance company to pay for a new roof. And sometimes those are absolutely legitimate, and then other times they're more gray. And that is adding to the cost of the insurance for everybody.
And I would say, even, and I'm sorry to interrupt you, but I would say even if it's more gray, look, I get it on one level, but I think that the roofing industry has found a funding partner, if you will. Let's just assume they're all legitimate, right? But
that's correct.
They've stepped up their game. Let's put it this way: they've stepped up their game in informing consumers that this source of funding for the roof might be available for them based on the damage. Is that fair?
Yeah, it is fair, and I think the key thing too is your insurance policy is not a maintenance policy. Right, so if your roof is 25, 30 years old, 20, or whatever age your roof is, because there's different materials being used, it's up to the homeowner to replace that, right? And so as a result of this, what we're seeing is insurance carriers changing their contract terms, or they're putting in depreciation schedules for their roofs. So if the roof is over X number of years, usually 15 or 20, they're going to start to depreciate that if there is a damage or repairs needed.
That makes sense.
Yes. So that's increasing the cost as well. The other increase is obviously we talked about claim history and let me see, claim history. Obviously, the natural disasters that we all have heard about that are increasing. We do get a lot of people say, yes, but it didn't happen to me. But if it happened somewhere near or overall, the carriers need to smooth those pieces out and smooth those claims through.
Isn't that really the whole point of insurance, right? Like at the end of the day, I buy into a pool with 1,000 or 10,000 or 100,000 other people to defray my individual expense. And so even if something doesn't specifically happen to me, it happens to the pool, right? And the pool needs to be beefy enough, if you will, in order to take the hits for the additional claims that might be coming down the road.
That is correct. And one of the biggest things, too, that we're seeing, if you're not on a coastal region, is some of the flooding or the sewer and water backup coverages. Those are something that everybody absolutely needs to make sure that they have on their policy. It does add some additional premium to the policy, but the reason being is because it's a huge source of claims. And people don't realize that that type of loss is not covered by a standard homeowner's policy. It has to be endorsed with that coverage added.
You know, Todd, it's great that you mentioned that, and it's a segue into some of the great work that your guys, you and your team have done for me personally. I literally had a sewer and water backup claim a couple of years ago, and it happened on one of these rainstorms that we get in Chicago a couple of times a year, right, where the water comes in and we get inches and inches of rain over the course of 12 or 24 hours, and even if you have some pumps like I did, they can be overwhelmed. And the next thing you know, you're standing in a couple of inches of water in your basement, and you need, at that point, you need two things, right? And number one is you need help, but number two is you need it financially covered. And I will tell you that in working with the restoration company, and this part of our conversation up to now has been kind of informative, but what I'm going to say next is absolutely an endorsement. In working with Todd's team, they were able to get involved with the restoration company that was not cooperating in getting a timely resolution, which could have cost even more money in terms of mold and additional damage and some of that other stuff, and then worked with them on the repairs over the course. And look, it was a significant claim. I mean, it was less than $20,000, but I think it was more than 10. And so it wasn't insignificant, and they did a great job. So I would thank you, but I think that the other thing that is really important to know is, look, these rainstorms, you think you dodge a bullet once or twice, but eventually your sump pump's going to fail, or your neighbor, they build a new construction house 3 doors down from you, and now the drainage changes, and all of a sudden you're up to your elbows, or really probably up to your ankles, in water in your basement, and you need help. You need this coverage, and it's not all that much more expensive, and it's certainly worth getting, right?
That is correct. And I would say, too, if we're getting in more into kind of just not why the rates are increasing, but every company has different rating factors, and it's so important now more than ever to work with somebody that has access to more than just one or two companies. We have some companies that for certain people, whatever their profile and their risk are and their address, one of our carriers who might be super competitive for somebody else is crazy expensive and out of the park for another individual. So it doesn't mean that every company is going to be cheap for everybody, but what it does mean is you're working with a team of people who really are looking at your best interest as a homeowner and only work with highly rated carriers, but do the work to make sure they're shopping out your situation to the market, because as I said, we are in one of the hardest markets that I've ever seen.
You know, Todd, I couldn't have said it any better, and I appreciate you jumping in on that. If somebody wanted to talk to you or somebody on your team about their insurance situation and see if you guys might be able to help them by, again, doing what you do best, which is working as a broker to find the right carrier for their situation. I don't want to pick on specific insurance companies, but you know, whether it's State Farm or Allstate or anybody else who's got a one name, they, for the most part, carry what they carry, and you either qualify with them or it's X expensive or not. You have access to multiple carriers, or somebody wanted to take advantage of that and ask you about it, how would they get in touch with you?
A couple ways. They can call us directly at our number on our website, or go to our website at LR-Windsor, that's LRWINDSOR.com. There's a red box on the top right that says get a quote, or they could send an email to info@LRWindsor.com and request a quote. But if they go on the website, they can put some information in there, and someone will reach right back out with them and personally take their all their information and take them out to market.
Awesome. Todd, is there anything else you'd like to share with us about the kind of cost of insurance and what's going on with that?
I think the only thing I would say is I would encourage everybody to really understand what their contract has. And no matter what carrier they're with or who their broker or who their agent is, there's a lot of things that people don't realize on their insurance contract until it's too late and there's a claim. So understand what your coverage is, how your coverage responds to different claims. What is your deductible? We've had some carriers change to percentage deductibles. We had one person that had no idea they had a $25,000 deductible. We were able to take that. It was insane. We were able to actually save them money and bring the deductible down to $2,000. It was a larger home, so the deductible was a little bit higher, but we saved them money, got them better coverage, and took the deductible from $25,000 to $2,000 just by having the conversation and having them understand their policy. So what I would want to leave everyone with is understand your policy, and if you haven't had someone review it to look at its market competitiveness in the last 2 years, then it would absolutely be behoove you to do that.
Todd, thanks so much for sharing that information with us today. I hope that things continue to go well for you and your team, obviously because you guys are helping me personally, but I hope that the information that you shared today was helpful for the audience as well. And thanks so much for jumping on and taking time on short notice to talk shop.
Absolutely, and as I said, it's LRWindsor.com. You can just get a quote on that thing, and if you want anybody to reach out to you, happy to talk to everybody. Thanks, Dylan, and thank you, and good luck with everybody who's on this call.
All right, thanks, Todd. Have a great weekend. You got it. Bye-bye.
Appreciate it. Thanks, Dylan. Bye-bye.
All right, awesome. So that's Todd Johnson from LR Windsor. And again, adding, as I mentioned, adding to the increased cost of insurance, to the increased cost of rates and payments, continues to add to our inflation situation in the market, and bringing it full circle on my conversations with Larry about why I think we'll have higher rather than lower rates going forward, is it does seem like with insurance and other places in life and in the economy in America in 2023, the predisposition is shifted for things to get more and more expensive. So that's what I've got for this portion of the program. I guess we're going to take a break, and we'll be back in a couple of minutes. Thanks.
Tune in to Real Estate Radio Saturdays at 9 a.m. hosted by the real estate therapist Larry Shakman, a top-producing real estate broker, author, CEO, and founder of TrustedAgentUSA.com. Top-performing agents for 2% commission, saving you thousands when you sell, buy, or invest. Real Estate Radio, the ultimate real estate radio experience. Get insider tips from experts throughout the real estate industry. Streaming live on Facebook at WCPT 820. Trusted Agent USA Illinois, license number 475145795. Welcome back to Real Estate Radio, sponsored in part by TrustedAgentUSA.com, the ultimate real estate matchmaker, saving you thousands. Now back to Larry, the real estate therapist.
All right, again, this is Dylan Kramer from Benchmark Mortgage. I'm flying solo on the real estate therapist's couch today. Larry's a little bit under the weather, and we wish him well, and hopefully we'll be able to still spend some time on the couch with you guys and talk a little real estate and a little shop. Thanks again to our guest in the last segment, Todd Johnson from LR Windsor. They are an insurance broker in Chicago and do a great job. Again, if you are interested in any information, you can send an email to info@lrwindsor, WINDSOR.com, or go to their website directly and hit the button for Ask a Quote. But Todd's got some strong expertise and talked a little bit about rising inflation. Speaking of rising inflation, one of the stats we talk about every week are the things that are released by the government. Consumer retail spending grew for the 6th month in a row, as reported this week. And again, consumer spending rising means people are spending more money, whether they're putting that on their credit cards or they're spending it in cash. They're spending more money, and it continues to be inflationary. So we're going to continue to see things move higher from an interest rate standpoint. I just don't see an argument now. Larry may be right. By spring, we may be falling again, but for now, I think we're predisposed to higher rather than lower rates. So let's check the show notes, talk about a couple of things. Let's see. Closed listings are at an 8-month low and a 20% drop year over year. Again, I think that talks to the idea that inventory is very, very limited in this market. And so you want to turn around and figure out how to get properties under your control. That's the situation with market conditions. And one of the stories I want to tell, or I've made notes to talk about today, is, we talk every week about the idea that folks are very, very interested in keeping their existing 2.5%, 3%, their sub 4% mortgage rate, right? We say it every week. We talk about it. But now let's talk about why. So I was introduced to a client recently who is in the midst of a divorce. It's not it's not an amicable divorce, but it's not ridiculously contentious either. It's not giant fights about things. But too often, I think people find themselves in a situation where they make decisions that impact their personal finances in a vacuum. Whether that's getting their insurance, as we talked about in the last segment, or getting this divorce for this client, or any folks who are getting a divorce. Folks make financial planning decisions and mortgage decisions independently. They have a plan to save money with their financial planner, and then I'll refinance to a 15-year mortgage, committing to an extra $800 a month that limits their ability to save. So you have to make integrated decisions. So this client phoned me and told me a little bit about her divorce situation and the house, and finds herself with teenage children in the house, as young as 13, with 5 or 6 years of school left, and they're in a school district, and she's got a couple of older kids that are closer to graduation, and was informed by her husband that he wants her to sell the house and move, or just he'll sign what's called a quit claim deed, which literally is what it sounds. You quit your claim on the real estate in exchange for her refinancing the house into his own name, or into her own name, so that she can remove him from the obligation of the mortgage. Why is that relevant? Well, in most situations, in all situations, let's say this first. If you sign a quitclaim deed and get yourself off the property, you're still on the hook or obligated on the mortgage. The two don't go hand in hand. You're not automatically off the mortgage just because you sign a document to take yourself off the house. So this husband was being, I think, prudent on one level in saying, hey, I would like you to do that. Now, they have already agreed on alimony or maintenance and child support, and are putting that out into have set the next 5 years of that kind of up, and how that cash is going to flow. However, in an exception to what is usually the case, this husband is eminently qualified to go buy another house for as much as, after working with him to do a pre-approval, as much as $600,000 or $700,000 worth of loan plus whatever down payment he would make in order to buy his next house. And the existing house, and that is with the existing house still on his credit report, for roughly $1,500, $2,000 a month. And so this individual came to me and said, I can't refinance because I'm only, I haven't worked outside of the home. I only have this income that's going to be the maintenance and the child support. And some of the kids are within 3 years of being 18, which means that income from the child support doesn't qualify for the next mortgage, which is a whole nother advanced conversation. But the thing that we did was we were able to look at everybody's finances and kind of give a dispassionate discussion that they should keep the 2.5% mortgage and negotiate for maybe a little less maintenance to pay it and just stay where they're at, because this particular individual, the husband, would not be encumbered or restricted. Very often in the divorce situation, the person leaving the house can't afford another house, can't qualify for another house without the reality of the staying house taking the mortgage out of their name. But the math proved different in this case, and we were able to help this client stay in their house. So although certainly my company is in the business of creating new mortgages, it is a real estate mistake to turn around and not do the numbers. We talked a little bit in the last segment with Todd about running the numbers on insurance, and the same thing is relevant on the mortgages. It is a top 10 mistake. Speaking of top 10s, I want to remind everybody that even though Larry is on the shelf today and not on the couch, you can get a copy of his book, The Top 10s of Real Estate, if you text the word book, B-O-O-K, to 630-921-0611. Again, text book to 630-921-0611. There's a lot of tips and tricks in there on Larry's that Larry wrote about his 23 years of experience in real estate and the mistakes that you can make that can cost you money. So again, text book to 630-921-0611. So I'm going to remind everybody about our sponsors real quick. Remember, At Home Title Service will get real estate agents paid as registered agents in Illinois. Sign up for the virtual event and go to their website to check that out. I'm going to also give a big plug for Benchmark Mortgage, which is my company. The fact of the matter is, if you need to get pre-approved, that discussion is a conversation we can have online or offline. We don't want to do it here on the radio because that's way too much personal information. But if you are interested in getting a second opinion or getting pre-approved, go ahead and text me at 630-708-7088. All right. Next conversation I want to have is a little more specific mortgage stuff, and we're going to talk a little bit about reverse mortgages. Why are we going to talk about reverse mortgages? Because this came up in conversation with a client as well this week. And so, one of the things that I think happens in life is we all kind of do what's called a short slice. And when we short slice, we see a quick idea and we make a decision about the whole thing based on that quick idea. And so one of the things that is out there for all the insomniacs is that you will see there is a handsome older actor who was probably on TV in the 80s or 90s, and today he's 70, 75 years old. He still looks good. He's got a full head of hair. It's gray now instead. Dress him up in a suit, and he can tell you that if you're broke, you can get money out of your house with a reverse mortgage, which, don't get me wrong, is absolutely true. However, the simplicity of the advertisement creates a situation where people will believe very, very quickly and easily that you need to be broke to get a reverse mortgage. And it's just not the case. As a matter of fact, one of the things that I talk to clients about all the time and financial advisors is the ideal candidate for a reverse mortgage is not the person who's almost completely out of cash, although it can help. We've had situations where people are flush out of cash and own their home almost free and clear or totally free and clear, and struggle to pay their property taxes, struggle to pay their medication bills every month. These are the sort of things a reverse mortgage can help that person with. But the person I'm really talking about right now is the person who's got a modest mortgage or a paid-off house and is doing okay. They've got $500,000, $800,000, $1 million in retirement money, but they're 65 or 68 or 72, and inflation is taking a big bite out of their monthly budget in a way that is forcing them to pull cash at a rate that's probably unsustainable if they're going to live to 88, 90, 92, because it's impossible to pull $50,000 a year from a $5 or a $6 or an $800,000 pool and make that pool last 25 years. The math just doesn't work. So again, in the mortgage business, we're always about the math. So with that said, what can that client do in that situation? Well, what they're experiencing is called a sequence of return risk, meaning that if the market isn't growing at a pace, or worse yet, the stock market is shrinking, they don't have the capacity to not only make their annual withdrawal, but they also have to turn around and they're not growing their pool. So they could run out of money. So what do? We set them up with a reverse mortgage, which could give, depending on the client, depending on the home, depending on the situation, could give them somewhere between $50, $100, $150 or more $1,000 in available equity, depending on the value of the house and their age, and put them in a situation where instead of drawing the money out of the stock market, leaving it in there to grow for another year or 2 or 5, and then using the increase in the value of that retirement account to pay the balance of the reverse mortgage later, or not pay it. Some things to keep in mind about a reverse mortgage, and I know that that's a complicated conversation, but there are some real questions or myths about reverse mortgages. First one is, hey, the government's going to own my house. Look, the FHA loan is a government insured loan. It's an FHA loan, much like a regular FHA for purchase. So they issue the insurance to the lender, which means that if you turn around and borrow on your reverse mortgage $200,000 and your house only sells for $175,000, the short version is the insurance will turn around and pay for the gap so that your heirs are not on the hook. Nobody loses their house. The fact of the matter is that the lender is not going to take your home. Your estate retains control of your home if you are no longer with us. And with any loan, including a conventional standard loan, the lender just puts a lien on the property and you pay that back. You don't have to make a monthly payment. You can, but you're not required to, which is so much easier than an equity line for that solution. And then in spite of the fact that a lot of people say, well, I have nothing left to leave my kids, I want to leave them the house. Your kids don't want your house. They're going to sell your house. They're going to pay off whatever mortgage is there, and then whatever money's left, they'll split. And honestly, if it helps you, for any reasonable kid, especially adult children who have children of their own, they want you to be comfortable. They want you to be in a situation where if it takes you over the course of 10 years putting a balance of $200,000 on the reverse mortgage, they'd much rather have you happy from a lifestyle standpoint. So there have been some real success stories. That's the bottom line. And you don't have to have a free and clear house. So that is my conversation today about reverse mortgages. The last thing I want to segue into is something that is near and dear to my heart, and that is a conversation or a brief kind of riff on serving veterans. You know, one of the things that came up years ago, my company here at the company I work for, Benchmark Mortgage, has a heart to serve veterans. More than anything else that we do, we're here to serve veterans. As a matter of fact, I remember I sat in a conference room in Dallas, Texas, where our corporate office is, in 2018, and listened to this discussion that I'm going to kind of share a version of with you now. So in 2012 or so, our company based in Texas where there are a lot of military veterans and a lot of folks who get it, started a charity event called the Boot Shoot. You can learn a little bit about Boot Shoot at bootshoot.com. But for those of you who are not Texans, the reality is it's like a golf outing with shotguns. It's basically a clay shooting event. There are a bunch of stations, 18, 20 stations, and everybody goes and they have teams, and it's a massive event. And they not only have that event, but there's a fundraiser and an auction and some other stuff. And so we were raising money for two charities. One was one doesn't matter. The most important one here is the Brain Injury Foundation out of San Diego. The Brain Injury Foundation is basically working with military veterans for where their veteran services kind of kick out. There's a lot of non-physical injuries for folks, and they get the treatment in their brains. We can raise at the annual Boot Shoot over $1 million. Some years we've raised $2 million, and we sponsor folks to go to those. Well, the winner, or the award winner, if you will, of the scholarship turned around and went to San Diego, and we were just going about our business. And our company, which is privately held, had the owner there with the scholarship recipient, and they were going through treatment. And unfortunately, the veteran's wife continued to go out in the hall, like, she'd been, excuse me, go out. This is going on over the course of days, right? It's not a one-day treatment. He's there for a couple of weeks. And the stress on her face is unbelievable. And finally, she was, frankly, confronted by one of the owners of our company. He said, hey, we're here on this scholarship. This is important to your husband. You keep stepping out in the hall. Like, what in the world's going on? And the next thing she said broke him down. And that is, you know what? I'm so sorry, but you've done so much for us, and I keep stepping out in the hall because I'm working with, and I won't name the name of the call center lender that wraps themselves in the flag, but they're just another mortgage company and not affiliated with the military. They tell me that I can't get the new house next week that we're supposed to take him home to because we're not qualified, and we're arguing about the mortgage and this and that. And literally, he looked at her and he said, you realize I own a mortgage company? Like, why are you not asking me to help? She's like, you've done so much already in this scholarship, and I couldn't ask you for another favor, and I feel so bad even telling you this because it's a burden. He's like, it's not a burden. Like, I'm going to take this from you right now. And what he discovered that day as an individual, what we discovered as a company, is too often in the mortgage space, veterans are traded on by companies, private companies, who don't have their best interest in mind. So the moral of that story specifically is, we basically moved mountains and closed that loan the next week. They're in that house, but we decided as a company that day, we're going to serve veterans at the highest level and give them a great mortgage experience. So what does that start with, or what does that look like? Well, the question I ask every single military veteran who's pre-approved for a loan by somebody else is, did that company pull your certificate of eligibility? Because if your pre-approval was not put together by the company with a certificate of eligibility, you're pre-qualified, not pre-approved, which you may understand after listening to this show for a couple of months. Pre-approval means you're actually good for the loan. But pre-qualification, dressed up like a pre-approval, means, we took a look at it, it should work. It's not good enough. It's absolutely not good enough. So you have to turn around and have that COE pulled. If your COE has not been pulled, you should work with a lender who does that as part of their pre-approval process. Now, we do, but that doesn't mean you need to work with us. You just need to work with a lender who knows what they're doing when it comes to VA loans and giving you a great veteran, giving you a veteran experience. So when we do that, we're able to deliver for folks. I am currently working with a veteran. He literally came from his service. He was staying on his sister's couch. He literally ended up in a car for a couple of months. And we were able to get him pre-approved based on his pending employment, because he got a job offer letter, and get him closed. And as long as we got that letter in the next 45 days after closing, and it might have been 30 days, but shortly after closing, he got his first pay stub. We were able to stick it in the file and close his loan and get him into a house. And so the point is, when it comes to VA loans, you better work with folks you know what you're doing, somebody who has a heart to serve veterans. We do at Benchmark Mortgage, but that's our story. Hey, am I here at the window? Devin, we got anything else?
We good to go?
What's my time? What do I got? 3 minutes? 2 minutes? 2. All right, we're going to talk for 2 more minutes. So let's turn around and talk about a couple of things. It is October, whatever it is, 21st. We're here at the end of the market. I've had a couple of conversations, both with veteran home buyers as well as some of the real estate agents that I work with, about the following idea. And we had it last year, and it turned out to be true, and I want to remind everybody of this now. The reality of the current market is this. If you are qualified to go out and be a home buyer, you should get pre-approved at the current rates and go shopping, because the people who are not serious are going to exit the market, which means you will have serious sellers in the market between now and the end of the year. Because you have serious sellers in the market, if you are a serious buyer, you can get yourself a fantastic deal. And again, if you get yourself a fantastic deal on a price from a motivated seller in the fall of 2023 at 8% or 8.25% or wherever rates end up on the day you go to lock in, and in a year or 2, rates are 6%, you just refinance later and lower the payment. But if rates are higher and go to 10%, you'll thank your lucky stars you bought at 8%. So that's basically the information we've got on today's show. I want to thank Trusted Agent USA, Benchmark Mortgage. Don't forget to ask Larry for the top 10s of real estate by texting him. And if you need anything else, don't hesitate to call me at Benchmark Mortgage at 630-708-7088. Other than that, we good? I got one more minute, and we're going to fill it. There you go. I thought they were telling me to wrap it up. We got 1 more minute. So with that said, let me get you the number one more time to text Larry, because that is the most important thing, is that you get his free book. And his free book is available if you text book to 630-921-0611. Again, 630-921-0611. Text book for the top 10s of real estate, and Larry will get you taken care of there. That's all I got. Awesome. Thanks, everybody.
Thanks for joining us on Real Estate Radio with your host, Larry Shakman, the real estate therapist and top producing broker. Now, go to TrustedAgentUSA.com and save thousands when you sell, buy, or invest. Illinois license number 475-145-795. Tune in next week for the ultimate real estate radio experience.
The preceding program, Real Estate Radio, was sponsored by Trusted Agent USA, and to the extent applicable, their guests. The views and opinions expressed therein do not necessarily reflect those of NewsWeb Radio Company or its management.